Hi, today we'll be evaluating frozen yogurt's financial model that will help us evaluate the growth as well as the feasibility of the business over the 5 years period. This will be done through input sheets, startup summary, financial statements, and dashboard. Moving on to the input sheet includes various assumptions taken upon for the business, such as owner's investment as well as loans taken by the business. This also includes different monthly employment payrolls, capital expenditure incurred, and other operational expenses such as electricity, employee entertainment, etc. Moving on to the startup summary includes various aspects such as funding against the total expenses incurred by the business, as well as different costs such as variable and fixed costs. This will allow the business to identify its costs in the long run and to reduce them accordingly to improve the profitability of the business. Moving on, this also includes the startup requirement of assets and the capital that will be needed. Moving on to the loan schedule. The loan schedule includes different types of loans incurred by the business and the respective interest that has to be paid as well as the principal amount that has to be returned to the lender. This allows the frozen yogurt business to identify its interest expense and record it, and so that the profit is not overstated. Moving on to the depreciation table, this allows frozen yogurt to keep a track of the fixed assets and to record depreciation on monthly as well as yearly basis. This will allow frozen yogurt to keep track of their assets and to not overvalue them and misrepresent them in their financial statements. Moving on to the revenue analysis, this allows frozen yogurt to project its sales over the 60 months period. For instance, the quantity sold is 5,000. If the quantity sold is increased to 10,000, the revenue will increase. However, the revenue can further be maximized if yogurt's segmentation percentage is increased to 100 as it has the highest average selling price. Moving on to the monthly P&L. Monthly P&L allows the business to track its performance and evaluate it on monthly basis using revenue, cost of goods sold, gross profit, operating expenses, and net income after taxes. Similarly, yearly P&L allows the business to track its performance on yearly basis using revenue, gross profit, total operating expenses, and net income after taxes. Moving on to the cash flow statement, the cash flow statement will allow the business to identify the activity that is generating most cash for the business, such as operating, investing, or financing. Moving on to the balance sheet, this summarizes the assets that the business owns as well as the liabilities that it owes. It also highlights the capital and equity section of the business. Moving to the project evaluation, this allows the business to evaluate its company and to know the internal rate of return, that is 112% in this case. Project evaluation also talks about burn rate analysis, that the cash has to be burned each year by the business. Moving on to the break-even analysis, the break-even analysis allows the company to know the break-even sales that it has to make in order to avoid any sustainable losses. Moving on to the diagnostic tools. The diagnostic tools summarizes income statement, cash flow statement, as well as balance sheet and break-even analysis so that the business is summarized and the decision can be made accordingly. Lastly, dashboard allows the business to have a virtual representation in form of charts, pie charts, and bar graphs in order to compare and evaluate businesses' performances in different aspects, such as profit and loss, break-even analysis, and balance sheet. These can be further broken up into utilization of funds, break-even analysis, fixed cost versus variable costs, etc. Thank you.